There is the minimum one can pay for a given amount of insurance coverage for a specific age, and the maximum one can pay. Who determines the minimum? The insurance company. At the other end of the spectrum is the maximum one can pay for a given amount of coverage, and who determines that besides you? The government. The fact that the federal government limits how much money one can put into a life insurance policy says what about it? It must be good. And it must be good in relationship to taxes. Basically, the government decided the upper limit of tax-advantaged growth they would allow, and the policyholders still have access to the cash value. Policies outside this allowable corridor are determined to be a modified endowment contract, or MEC, which simply means the government will treat the insurance contract like they do qualified plans, with all the rules, regulations, and penalties. After watching this video, you will probably know more about life insurance than most life insurance agents, should you ever have to talk with one again. At a minimum, you will probably know more than they are willing to tell you. There's almost an infinite amount of premiums that can be charged between the minimum and maximum. As mentioned earlier, the insurance companies determine the minimum. They have actuaries that calculate the least amount of premium they can charge and still make a profit. They understand opportunity cost, which means they have factored in the time value of the premium. In the 1980s, the government drew the line that determined the maximum amount of contributions allowable for a given face amount of coverage. This is when the terrible twins were born, Tamra and Defra. The government said, wait just a minute. We cannot let people put unlimited contributions in a life insurance policy as is allowed currently, because if we do, they will not do what we encourage them to do. What does the government encourage you to do besides pay taxes? They encourage putting your money in a qualified plan account and defer the taxes. Samples of these accounts include 401ks, IRAs, SEPs, and 403b plans, just to name a few. Who came up with these plans? The government. What do qualified plans do? The number one response is that they defer taxes. If that's what you said they do, you were only half correct. Let's say you wanted to borrow $10,000. You would ask two questions before you took the money. The first question would be, how much interest do you have to pay? The second question would be, when do you have to pay it back? If the lender responded by saying, we have enough money right now and don't need any payments from you at this time, but there will come a time when we will need the money. When we know how much we need, we will be able to determine how much interest we have to charge to get the amount we need. Would you cash that check? Absolutely not. But this is exactly what we are doing with the government in qualified accounts. They are not saying you do not owe the tax. They're saying you can pay the tax later. At what bracket? That is a good question. This is not to say that qualified plans are bad. However, it is important that you know and understand exactly what they do. Now, getting back to insurance, let's assume you could pay $500 for $500,000 of insurance coverage, or you could pay $10,000. Which would you choose? Being bargain shoppers, most of us would probably say $500. Less is best when it comes to cost, right? Let's say the $500 represents the lowest premium one can pay for $500,000 of coverage at a given age. The lowest premium is known as term insurance. It provides one benefit, death benefit. Term insurance offers protection for the least expensive initial cost. The best day financially to own term insurance is which day? If you guessed the day you die, you weren't even close. The best day financially to own a term life insurance policy is the first day. That's right, it is the first day you buy it. Had you purchased the policy today, received approval, signed the delivery receipt, paid the first premium, and died on the way home from your agent's office, you cannot get better than that financially. To calculate the rate of return on such an event would be next to impossible. Granted, it would be hard to get people to sign up for this type of financial windfall, but you understand the point. If the best day to own a term policy is the first day, it means that every day you own it, it becomes worth less and less, costing you more and more. How do you feel about owning things like this? When determining the cost of term insurance, one must also factor in the opportunity cost of owning this product. Remember, the cost is not just the amount you paid in premiums, but what those dollars would have earned had you not bought the coverage and taken the risk yourself, which we are not suggesting you do. Penn State University completed a study in 1993 on term insurance policies where they discovered that more than 90% of all term policies are terminated or converted. 45% within the first year, and 72% within the first 3 years. Less than one policy in 10 survives the period for which it is written. After 15 to 20 years of exposure, less than 1% of all term policies are still in force, and only 1% of all term insurance resulted in death claims. What does this mean? It means with term insurance, you will most likely pay more than you receive. For an insurance company to talk you into putting $10,000 in a policy with a value at your death that you could get for $500, they would have to come up with some serious benefits, agreed? Let's forget about insurance for just a minute and talk about benefits. In any vehicle one would use to accumulate money over time, a major desire would be to maximize benefits in addition to achieving an acceptable rate of return. If you could wave a magic wand, what benefits would you desire? Would you like the money in the account to grow tax-deferred as opposed to taxable? Would you want the money to come out tax-free? Would you want a competitive rate of return? Would you like the interest guaranteed? In the event you get sued, would you want it protected from judgments? Would you like to contribute as much in the account as you desire without restrictions? Would you like to invest in anything you choose? Would you like to be able to use this money as collateral? If possible, would you want this money exempt from estate tax? Would you want access to this money while you are working, as well as during your retirement? In the event of your disability, would you want your contributions to the account to continue even though you can no longer make them yourself? Would you want your contribution to this account to be tax deductible? Of course, you would want all these benefits if you could get them. Which of these benefits do you get from a qualified plan? There is only one product that offers the majority of the benefits on the list, and it is permanent life insurance. However, not just any type of contract will do. Life insurance policies that are minimally funded only provide minimum levels of benefits. Remember, the government drew the line that determined the maximum amount of contributions allowable for a given face amount of coverage. Contributions over this line create a modified endowment contract, or MEC. However, contributions made right up to this line create a different type of MEC that we call the maximum efficient contract. Permanent life insurance contracts offer all the benefits listed earlier, except that the contributions to a life insurance contract outside of a qualified plan are not deductible. You may be surprised to learn that there is little to no difference between deductible and non-deductible contributions. In fact, tax-deductible contributions that grow tax-deferred and come out taxable are exactly the same as after-tax contributions that grow tax-deferred and come out tax-free, assuming the same tax bracket and investment interest rate. What you need to understand is that as you move from the highest possible premium to the lowest, the value of the benefits decrease. The higher the premium, the higher the level of each benefit received until you reach the MEC line. Up to that line, but not over, is the position that provides the greatest amount of benefits a life insurance contract has to offer, while still allowing liquidity, use, and control of the money. There are circumstances where one only needs death protection and a low-level premium is desirable. In this situation, and when coverage is needed for a short period of time, term coverage may be the best immediate temporary solution. If, however, you're looking for a place to accumulate money that provides the highest level of benefits mentioned at their maximum level, permanent life insurance is a great choice. Currently, we know of no other financial product that offers these same benefits at the same level. Insurance companies limit the amount of death protection one can purchase, known as the face amount, based on present age, mortality costs, current assets, and income. The government set the MEC guidelines to limit the amount of contributions allowable in the form of premium payments that still give the policyholder access to the cash value on a tax-favored basis. How much insurance should you have? Most of us assume this is a needs decision. This should really be a wants decision, not a needs decision. There is no one wise enough to determine what one needs, since the very thought of need represents the least amount. To determine the least amount would be to assume that if one has this amount, they would be fine. It would be hard to find anyone who has been successful at anything who started off doing the least they have to do to make it. Life insurance should be considered a want product. You decide what you want to happen. Then it can be determined how much coverage it will take to accomplish what you want. Life insurance will provide the immediate funds to guarantee that what you want to happen will happen in the event of your death. Make sure your policy will ensure that what you want to happen will happen.